Wall Street says buybacks make your shares worth more. The math doesn't work that way. The conventional story is simple. When a corporation buys back its own stock, there are fewer shares outstanding. Divide the same earnings by fewer shares and earnings per share rises. Higher EPS signals growth. Stock price follows. It's elegant. It's taught in business schools. It's also a mechanical illusion that obscures what's actually happening to shareholder value. Here's where the first crack appears. When a corporation spends cash to repurchase shares, that money is no longer in the business. It can't fund R&D, pay down debt, or build new facilities. You've swapped an asset, cash, for a liability reduction. The balance sheet hasn't grown wealthier, it's been reshuffled. But the real mechanism sits deeper. Buybacks became a tool of financial engineering after 2003, when SEC Rule 10b-5-1 made them legally safer. Executives realized they could suppress share dilution from stock option packages without looking like they were simply enriching themselves. The optics worked. The value creation didn't. If a company buys back shares at peak valuations, which many do because executives' compensation is tied to stock price, they're destroying shareholder wealth. They're paying inflated prices for pieces of a pie that isn't growing. The EPS number goes up on paper. The actual pie stays the same size. What actually moves share price is revenue growth, margin expansion, and competitive advantage. Buybacks are a signal that management has run out of ideas for deploying capital productively. They're a tax-efficient way to return cash to shareholders without paying dividends. But returning capital isn't the same as creating it. The system feedback loop is what predictable analysts saw coming. As buybacks became normalized, trillions of dollars over 2 decades, they propped up stock indices artificially. When growth slowed and companies had less cash to deploy, the buyback machine stuttered. The collapse of 2008 wasn't mysterious. The mechanism was visible years before. Today, buybacks remain a legal loophole for avoiding the harder work of innovation and reinvestment. They benefit executives with stock options and long-term shareholders who exit at the right moment. But they don't create durable competitive advantage. They're financial theater, dressed up in the language of shareholder value. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the systems that shape wealth, the mechanisms that were built to concentrate it, and the ones that broke under their own weight. This video is for educational and informational purposes only and is not financial advice. Always do your own research.